Welcome. Today we'll be looking at our consolidated statement of financial position. And the best way I thought I could demonstrate this is by basically sharing an illustration which we will do together. I will show step by step how we're going to calculate this. So let me read the example. The statement of financial position of Coppermelt University Group and its investee universities, Kapata Makata University and Peter Mushingo University at the 1st December 2015 are shown below. So now we have the statements which have been shown below here. As you can see, these are statements of financial position summarized for the three companies: CMU Group, KMU, PMU. All right. So these are the statement of financial position. You can see non-current assets, current assets, total assets there, equity and liabilities, and everything. And it's balanced as the total assets are equal to capital plus liabilities. I will discuss that. So if you're doing consolidated statement of financial position, the first thing you do is to visit the notes. So I'll go straight to additional notes. Okay, note number 1, CMU acquired 600 ordinary shares in KMU on 1st January 2010 for $1 million when the retained earnings of KMU were $200,000. Note 2, at the date of acquisition of KMU, the fair value of each freehold property was considered to be $400,000 greater than its value in KMU. Statement of financial position. KMU had acquired the property in January 2010, and the building element in brackets comprising 50% of the total value is depreciated over 50 years. Note 3. CMU Group acquired 225,000 ordinary shares in PMU on 1st January 2014 for $500,000 when the retained earnings were $150,000. Note 4. KMU manufactures a component called the Ringo, used by both CMU and PMU. Transfers are made by KMU at a cost plus 25%. CMU held $100,000 inventory of the Ringo at the 31st December 2015. In the same period, CMU sold goods of which PMU had 80,000 in inventory as at 31st December 2015. CMU had marked these goods up by 25%. Note 5. The goodwill in KMU is impaired and should be fully written off. An impairment loss of $92,000 is to be recognized on the investment in PMU. Note 6, which I guess is the last note. Note 6, non-controlling interest is valued at full value. KMU shares were trading at $1.60 just prior the acquisition by CMU Group. All right, so it's the notes that we basically look at first before we can consolidate the statements, because what happens here, we need to identify whether there is a subsidiary, whether there is an investment in associate or anything of that nature, and then see which one will qualify for consolidation and which one will be indicated as an investment. So the first thing we'll do is to do the workings, and the workings are based on the notes. So the notes, they carry the workings. So the first working that we need to do actually is the group structure. So let's see how we get the group structure. Let's see who bought who. So the CMU in note 1 acquiring 600,000 shares in KMU. for 1 million. Where else do we see a purchase? There is another purchase in note 3. CMU Group again. It's the CMU acquiring 225 ordinary shares in PMU on 1st January 2015 for $500,000 when the retained earnings were actually $150,000. So group structure. Let's do the group structure quickly. That's the first working one. In one group structure, so I'm doing the group structure here. Structure, we're basically looking at the purchases. So CMU purchase in CMU purchase in KMU. The notes are saying they purchased 600,000 shares. So we need to identify how many shares were in KMU. CMU purchase in KMU. How many shares were in KMU? When we check from the statement of financial position, where it says equity there, so share capital is there. So the shares in KMU is basically $1 million. So $1 million, this is in monetary form. We need to convert it to number of shares so that we can know the proportion which was bought. But we can see here to say per share, it's actually $1. So $1 divided by 1 million shares, $1 divided by $1 million, we've got 1 million shares. So there were 1 million shares in KMU, and CMU only bought 600,000. So what percent will be this? So what percent will be this? 1 million here, multiplied by 100. The 1 million I'm putting on the bottom there, it's not $1 million, it's 1 million shares. We divided $1 million divided by $1 per share. So multiply by 100. If I process this on my calculator, it's giving me 60%. So we bought 60% of KMU as CMU. Again, the same CMU purchased. CMU purchase in what? In PMU. How many shares did they purchase? We've been told from the note to say they purchased 225,000 shares. Okay, 225,000 shares. We need to check quickly. Yes, it's 225 shares there on note 3, but we need to check quickly what's the number of shares in PMU. So the number of shares in PMU is $750,000. Now $750,000 multiplied by $1 per share will give you 750,000 shares. So out of the total of 750,000 shares, we purchased 225. That multiplied by 200, or that multiplied by 100 gives me 30%. So we bought 30% of PMU. Now, for something to qualify to be a subsidiary, meaning to become a non-controlling interest, we need to buy in it 50 or more shares. We need to buy in it 50 or more shares. So as you can see here, it's 60. So KMU is a subsidiary, but PMU is just an investment because we haven't reached 50. So we'll draw the group structure, which needs to look like this. It has to be neat. It needs to look like this. And group structure, insert. Yes. Purchase in KMU and purchase in PMU at different dates, of course. So here I will indicate CMU as the parent company. And then here I will indicate KMU. KMU here. And then here I will indicate PMU. And then here I'll say from CMU to KMU, that's 60%. From CMU to PMU, that's 30%. Of course, on different dates. So that's my first working. The second working, I need to calculate goodwill. So how do we calculate goodwill? Working number working number 2. Working number 2 is goodwill. How do we get to calculate goodwill? All right. So goodwill will be calculated by the formula. There's a formula for calculating goodwill. Goodwill is simply equal to consideration value. How much you bought the business? Consideration value plus NCI, which is non-controlling interest. NCI at acquisition minus net assets. Net assets is equivalent to capital. For those of you who remember the accounting equation, which suggests that assets is equal to capital or equity plus liabilities. If we are making capital the subject of the formula, we'll move liabilities to the left-hand side, and when it crosses the sign, it becomes a negative. So we'll say total assets minus liabilities is equivalent to capital. So for us to get the net assets, we just basically indicate the capital elements of the business that we are actually purchasing. All right, that's understood. So goodwill is calculated as consideration value plus NCI at acquisition minus net assets. So let's calculate the goodwill. Let's calculate the goodwill. So here, consideration value. Consideration value here will be what? Consideration value is how much we paid. Consideration value is equal to how much we paid for KMU. KMU we paid $1 million. Or maybe let me put tables here so that our work looks neat. Sorry, how will we do that? Okay. So now we are calculating our goodwill. Do that. Okay, so we'll say consideration value. Let me put the $1,000 there. $1,000. Let me put the $1,000 there. So consideration value will be how much we purchased. So we are saying 1 million. So 1 million there, $1 million. Then NCI at acquisition, non-controlling interest at acquisition. Remember, there is a note on non-controlling interest, and the note says non-controlling interest is valued at the full value. KMU shares were trading at $1.6 just prior to the acquisition. So non-controlling interest is the share of KMU. So KMU, we bought 60% of KMU. So KMU is remaining with 40% of its shares. So if you look at the shares of KMU here, the shares of KMU is 1 million. So we are doing 40% of 1 million. That is NCI because we bought 60%. So 60% has gone to controlling interest. What has remained in non-controlling interest is 40%. So I'm saying 1 million shares multiplied by 40%, multiplied by the value of a share. The value of a share is $1.6. $1.6 per share. This will give me what the non-controlling interest is at the date of acquisition. This is at the date of acquisition. Let me indicate so that there is no confusion. This is at the date of acquisition. Okay. This is at the date of acquisition. So what are we getting there? We're getting 640. So total here will be, the total here will be what? The total here will be 1640. So now from the 1640, we need to less the net assets. We need to less the net assets. So net assets here, less net assets according to the formula for calculating goodwill. And I said net assets represents the share capital. So now share capital for who? We are dealing with the subsidiary, which is KMU. We are not dealing with the investment. The investment will come and do with it later. Share capital of KMU. The value is $1 million. And then after share capital, we have retained earnings. Retained earnings is part of capital, remember? Retained earnings at acquisition. We push this value this side. So retained earnings at the date of acquisition. Retained earnings at the date of acquisition, we've been told that the retained earnings for KMU, the time they were acquiring it, is 200. It's right in the notes. We get there. Same, you acquired 600 shares of KMU on 1st January 2020 for $1 million when the retained earnings were $200,000. So $200,000. $200,000. We got 1,000 on top there, so I'm not worried. And then we have information here which is saying there was an increase in the assets of the company at the date of acquisition, meaning one of the assets had its fair value increased. So meaning that increases capital in KMU. There is this note here, note what? Note 2. At the date of acquisition of KMU, the fair value of its freehold property was considered to be $400,000 greater than its value in KMU statement of financial position. So 400 fair value adjustment. Fair value adjustment. It's $400. Okay. So now adding these net assets, 1,000 plus 200 plus 400, that's 1,600. So here we have literally what we are calling as 1,600,000 as our total net assets. These net assets, we're going to subtract them from the consideration value plus NCI, as the formula is saying, to get our goodwill. So our goodwill will be 1,640 minus 1,640. Okay, so that's our goodwill. So we have our goodwill like that. So the next thing we are going to calculate now is is the things that affect retained earnings. So the next big thing that we need to have ratings for is retained earnings itself. So that would be our working to put it later. So we need retained earnings, but retained earnings is affected by a few things that we need to calculate. Number one, retained earnings is affected by depreciation. Remember, depreciation reduces depreciation is an expense and it reduces the profits in the business, and retained earnings are basically profits which have been accumulating over time. So now, why are we interested in calculating depreciation for this particular question? We need to calculate depreciation because of an increase in the fair value of property. If you see here, on note number 2, at the date of acquisition of KMU, the fair value of its freehold property was considered to be 400,000 greater than its value in KMU statement of financial position. KMU had acquired the property in January 2010, and the building element comprising 50% of the total value. So 50% of the total value is 50% of the 400 and is depreciated over 50 years. So meaning that 50% of the 400, which is 200, will be depreciated over 50 years. And then from January 2010, to date, which is 2015, how many years has passed? 2010 itself, 1 year. 2011, 2 years. 2012, 3 years. 2013, 4 years. And 2014, 5 years. And 2015, 6 years. So we need to account for depreciation for 6 years. All right. 2010 itself, 2011, 2012, 2013, 2014, and 2015. That's 6 years. All right. So we need to account for depreciation for 6 years of half of the 400, because we are saying maybe freehold property has got land and we are assuming land does not depreciate. It is only the building element that is going to depreciate over a period of 50 years. So let's see how we calculate this one. Okay. So we'll say depreciation. There, depreciation is based on the half of 400. What is for half of 400? So half of 400,000. Okay, they're saying 50% of that. So 50% of that, which is $200. So $200,000. $200,000. This $200,000 will be depreciated over 50 years. So I'll divide by 50 years. So that will give me 4,000 per year. So depreciation is 4,000 per year. And then we are saying from January 2010 to date, 31st December 2015, that's 6 years. So the depreciation amount that we'll be talking about is basically $24,000. Okay, that's the depreciation amount that we'll be talking about, $24,000. It will affect the retained earnings. So and then the other thing that we need to look at is unrealized profit. The unrealized profit is only goods which are sold within the group. So let's look here. On the sales of goods, the sales of goods is note 4. Note 4 says KMU manufactures a component called KMU manufactures a component called the Ringo, used by both CMU and PMU. Transfers are made by KMU at a cost plus 25%. CMU held $100,000 inventory of Lingo at the 1st December 2015. What is unrealized profit? Unrealized profit is when there is intra-trading within the group, and then you realize to say not all the goods have been sold to the outside. Some of the goods are still within the group. So we have the profit which we are calling as unrealized profit. So we need to calculate unrealized profit for KMU. We calculate unrealized profit, it affects the company that is selling. So in this case, it will affect KMU when it comes to the goods which are held by CMU, which is the $100,000 in inventory. In the same period, CMU sold goods of which PMU had $80,000 in inventory as at 31st December 2015. CMU had marked these goods up by 25%. So there are two unrealized profits that we're going to calculate. Number one, for $100,000 as pertaining to the goods that KMU transferred. So therefore, it's KMU who suffer unrealized profit. And also $80,000, which was held by PMU, and it's CMU who sold. So the selling company is the one who suffers the unrealized profit. So let's see how this goes. So for the 100 for KMU, in relation to KMU, the 100, which was marked at 25%. So if we are calculating the sales for something, we want to add the profit. This is how we add the profit. We'll say cost plus the profit. Plus the profit is 1 plus the profit element. This should equal to sales. This should equal to sales. So now we have the cost, which we don't know. We are interested in the profit element. We want to know the unrealized profit. These were marked up at 25%, which is 0.25, and the sales were $100,000. Okay. So this will go to what? Okay, so this will go to what? Let's see. So this is the 1 plus 0.25 in brackets, 1.25. 1.25 cost being equal to $100,000, $100,000. This will be that. Then the cost will divide both sides by 1.25. So when we say 1.25 divided by 1.25, the 1.25 will be gone. The other side it will be $100 there divided by 1.25. All we're trying to get is the cost. So here it gives me 80. 100 divided by 1.25, it gives me 80,000. So if 80,000 was the cost, if 80,000 was the cost, what was the profit involved? The profit involved should be the sales value, which was $100,000. $100,000 minus the cost, which is $80,000. $80,000. This will give me a $20,000 as my profit. So that's the unrealized profit that will be suffered by who sold. Let me check who sold again. Transfers are made by KMU. So this is the what KMU will suffer. KMU is the one who sold that. So this is the unrealized profit for KMU. Let me get the KMU. I go to the unrealized profit for, there's another company which sold. CMU sold goods of which PMU had 80,000. So CMU sold to PMU. So there's an unrealized profit again. CMU suffered an unrealized profit. So the same principle will be applied. but this time around we are looking at unrealized profit with regard to CMU. Unrealized profit as with regard to CMU. CMU, the value was 80,000 instead here, which was due in inventory. So I'm just changing that. 80,000 here. That was the value because the percentage is the same. They both marked up 25%. And here, what will it give me? 80 divided by 1.65. 80 divided by 1.65. We have 80 divided by 1.25. We have 64,000. This is the cost. So the profit will be if the sales was 80 and the cost is now $64,000. The profit will be 16,000, but the loss will go to the unrealized profit, will go to CMU because it's CMU who sold these goods. So I have the elements that should go in retained earnings working. So let's see how the retained earnings working are going like. Let's see the workings for retained earnings, the way it will go. So here are the workings for retained earnings. Here are the workings for retained earnings. What were the retained earnings as per statement? Okay. So we need to look for the retained earnings in the statement. We need to look for the retained earnings in the statement. Where is the statement here? The statement is there. So we need to look at the retained earnings in the statement. What were they? So retained earnings for CMU, the first company is CMU, the second one is KMU and PMU. So retained earnings, as you can see here, for CMU, it's 1,460. For KMU, it's 885. For PMU, it's 390. So now I'm fusing these in my workings. As per statement for CMU, it was 1,460. For KMU, it's 885. For PMU, it's 390. Okay, so I have the values there. Now I need to say less retained earnings at acquisition because I'm interested in the retained earnings after we've acquired this because that's what we share. So let's look at the retained earnings at acquisition for both KMU and PMU. Retained earnings at acquisition, you can only see it in the notes. Same you acquired in KMU. On 1st January, the retained earnings at acquisition were $200. This one here, which I've shaded, $200. And the acquisition of PMU, the retained earnings is in note 3, which is 150,000, which I've shaded there. So 200 and 150 respectively. So let's see. 200 here, put it in brackets. I'll just put a negative here, 200 here. Then 150 there. Post acquisition, what do we have here? That is 885 minus 200 will give us 685. $390 minus 150 will give us 240. Okay, we need to push in unrealized profit. So we've already calculated unrealized profit. There is CMU and KMU in terms of unrealized profit. There is KMU and CMU in terms of unrealized profit. We need to subtract it. So the unrealized profit that we calculated were actually unrealized profit. We've already calculated this. That which pertains to KMU is 20 and CMU is 16. We are listing it there. CMU 16. KMU 20. So here we'll get, when we say 685 minus 20, we'll get 665. And then here, there was nothing in terms of that, so it will still be 240. And here we have 1460 there minus the 16. One, 4, 4, 4, like that. Okay, so we have that value there. There was impairment in subsidiary, and there was impairment also in an investment. This will reduce our profits. Impairment, for lack of a better term, can be looked like the way we treat depreciation like a cost. It's an expense to the business, so it reduces the profit. So let's read the notes on impairment. Let's read the notes on impairment. There is a note on impairment. There is a note on impairment. Okay. On goodwill, yes. Number 5. The goodwill in KMU is impaired, and this should be fully written off. So goodwill in KMU, we calculated the goodwill to be what is the calculation for goodwill? We calculated the goodwill to be 40,000 there in KMU. So that one will be fully impaired. And also, apart from that, an impairment loss of $92,000 is to be recognized on the investment in PMU. So again, in investment, we suffered goodwill of 92. So there are 2 goodwill that we'll deal with. So goodwill in subsidiary, that is $40,000 is going to be removed. That's what we calculated as the goodwill. Then goodwill in investment, which was impaired, is 92,000. This one we've just been given, we did not calculate it. And then depreciation, we had calculated it. If you remember, depreciation was 24. Well, is it? I was talking about depreciation. Let's just see. You will see why we are calculating depreciation that way. This was the calculation for depreciation. This one here, 400, then 50% comprising building, which is 200, then it will be depreciated over 50 years, then it was 4,000 per year. Then from 2010 January to 2015 31st December, 6 years had passed. So depreciation per year is 4,000. So it has depreciated over the last 6 years by 24,000 there. So 24,000 is the depreciation. $24,000 is the depreciation there, which I've been getting. Now, share of profits. Let's see how these profits will be shared. The one for KMU, the profit is the profit, yes, after the necessary cost. KMU, the profit is 665. So in KMU, we own 60%. So 665 multiplied by the 60%, which is 0.6 there. Gives me 399. So it's a share of profit. So we are gaining, we are not subtracting, we are getting our share of profit. In PMU, 240 there, we own 30%. So 240 multiplied by 30%. That's 72. So our group retained earnings will be this minus the 40 there, minus the 92, minus the 24, plus 399, plus 72. So my group retained earnings will be $1,759,000. Okay. My group retained earnings will be $1,759,000. Now I need to calculate two more things. That's NCI and investment. So we'll be calculating NCI and investment. Group retained earnings here. I'll put the workings here. These are workings for group retained earnings. Consolidation statement, they can be involving, so you need to really pay particular attention. That's how it looks like. All right, so now I'm calculating non-controlling interest. The next working is non-controlling interest. This was working number 1. Retained earnings should have been working number 3. So NCI is working 4. So NCI, non-controlling interest. Basically NCI. We have NCI at acquisition. Just put a small table here. NCI at acquisition. We have calculated NCI at acquisition. If you remember, the non-controlling interest, the shares of KMU in total is 1 million, and we bought 600,000, meaning the NCI allocation is 400,000 shares. 400,000 shares, and then we say 400,000 shares here multiplied by 1.6 dollars. We have calculated this already, so we already know this calculation. NCI at acquisition was 400 multiplied by 1.6, which gives us 640,000. Dollars. Okay, and then the share of NCI, the profit for KMU, the retained earnings for KMU is 665. So if it's non-controlling interest, they only have 40%, because controlling interest is 60%. So 0.4 of that. We have 266. Total here. The total for this one will be 906. $906,000. Okay, so that's the NCI that will come into the consolidated statement. To look like that. So now bridging from here, we need to calculate now investment, question number 5. Investment. Investment, question number 5. So investment again, I need to do a table. Investment at cost. This investment, if I can recall, it was bought at $500,000. Let's see. Yes, investment in PMU, $500,000. There it is. And then apart from investment at cost, We need a share of profit. Share of profit. Profit for investment. Profit for investment was 240. Can be seen from here. Post acquisition profit 240. So 30% of that. The next is impairment. Remember, there was an impairment which was emphasized to say there is impairment of sorry about that. There's impairment of 92,000. Now this one is a negative. It reduces the investment. I'll go back to that note, which should be recognized as with regard to investment. Okay. So now what I have here is 500 plus 72 minus 92. I'm getting 480. 480, that's how much the investment is. So we're done with all the workings. Let me just show you where the 92 was coming from. Here, note 5. An impairment loss of 92,000 is to be recognized on the investment impairment. So we are done with all the workings. Now it's the time to consolidate the statements. So now we are consolidating. I just don't know how far it will go, but we are consolidating now statements. Let me just start it on a new page. I'll be scrolling, going up and down. But let me start it on here. So we shall say CMU, consolidated, CMU group, sorry. Consolidated, the heading itself is a mark, consolidated statement of financial position. Consolidated statement of financial position as at 31st December 2015. As at 31st December 2015. Just like I said, not knowing how far it will go, so I'll put a very long table for this one, where it will end. This is 22. Let me try to put at 25, then those ones, no, column, this 25, this one 2. just like that. This will be enough for me. So we are starting now. We are basically following the format of the original statement. So I'm starting now. Here I'm putting dollars in $1,000, and then we are starting with the non-current assets. Non-current assets. Non-current assets, we have freehold. We have freehold property. Let's see the things that will go in freehold property. As we consolidate, we only add or we only consolidate the things that pertain to a subsidiary which was over 50%. The investment will just include it as one of the non-current assets under assets. So we are consolidating as with regards to the subsidiary. So it's only CMU and KMU. So the freehold property there, in the statement, we've got for CMU 1950, for KMU 1250. So I'm adding those two plus the adjustment that I'll take into consideration. So I'm adding 1950 plus 1250. Adjustments, there was a property which went in value up in terms of freehold by 400. So I need to add it. There, note 2. At the date of acquisition, the freehold property was considered to be 400 higher than its value. But I'll also take into consideration the depreciation. We've already calculated the depreciation. The depreciation was 24. Where is it? Anyway, I remember the depreciation was 24. So 400. Then there was depreciation of 24. Depreciation reduces the assets. So there I'll have that 1950 plus 150 plus 400 minus 24. I'm getting 3576. Plant and machinery. Plant and machinery. Plant and machinery. I need to check. So plant and machinery is actually, for the two companies, plant and machinery is actually 795 and 375. You can see here. We are only consolidating the group and the subsidiary. 795 and then 375. So 795 plus 395. What I'm getting is What I'm getting is 1,170,000. Okay. Next thing that we need to put here is goodwill. Remember, we had calculated our goodwill, which is 40. The goodwill was 40. The goodwill calculated was 40 here. Goodwill there, 40. But funny enough, the examiner said the goodwill in KMU, the whole of it was impaired. If you remember the notes, let me get there. The goodwill in KMU is impaired and should fully been written off. So it has to be written off. So if it's the goodwill, if it was 40,000, meaning I found the 40,000 there as goodwill, but I need to write it off again, minus 40. So this will be 0. That will be 0 on goodwill. Then remember investment, we worked it out. I said investment will be part of the non-current assets. So investment, we had worked it out. We have the value for investment. This should be working. This should be the last working. Was it working? Let me see. Investment, let's go there. Investment here, working 5. Investment was 480. W5, so that I show where it's coming from. 480. And then I can calculate my non-current assets here. 3,576 plus 1,170 plus 0 plus 480. What am I getting? I'm getting 5,226,000. 5,226,000 dollars. Okay, that was just non-current assets. Now I'm starting current assets. Current assets. Current assets. We have inventory. Inventory for the 2 companies, KMU and CMU. That's 575 plus 300. Now you remember we had calculated unrealized profit. We have 2 unrealized profit. They are supposed to be subtracted from inventory value. They reduce the value of inventory. Unrealized profit, where is it? We have the 20 there. If you can see the unrealized profit here, we have 20 for KMU and 16 for CMU. So now inventories, we say the inventories we've got 575 plus C 300 minus C unrealized profit 16 for CMU and 20 for KMU. What are we getting after that? Wow. We are getting 839. Another current asset which is there is receivables. Receivables, I'll check quickly. On the statement, trade receivables 330 here, 330 and 290. Don't get surprised why we're not adding for PMU. We said PMU is not being consolidated because it's not a subsidiary its investment is less than 50%. It's only 30%. So we only consolidate the parent company and the subsidiary, then the investment just comes in as an asset. So 330 plus 290, trade receivables. These things are nice. 330 plus 290. What do we get? 620. Cash and cash equivalent is another current asset. Cash and cash equivalent is another current asset that has been stated in the statement of financial position. What do we have on cash and cash equivalent? $50 and $120 cash and cash equivalent here. 50 and 120. That's 170 when we add it. So now it looks like this was the end of my current assets. I can add them. They're giving me 1629, like that. 1,629,000, like that. Then I can have my total assets here. Meaning on the asset side, we've closed. I'm going to equity and liabilities, which is capital and liabilities. So the total assets will be current assets plus non-current assets. So 5,226 plus 1,629. I'm getting 6,855,000. I start a new chapter here, which is the equity and liabilities. Equity and liabilities, we are talking about capital and liabilities. I need this total assets. I need it to be separated. It's a very special item. I have marked it yellow. So we have share capital here. Share capital, we don't consolidate, we just put for the parent company. Share capital, we don't consolidate, we just put for the parent company. So share capital for the parent company was what? Equity. The current company is on the middle. The parent company is on the middle. What is the equity element? Oh, sorry, the parent company is at the end. That's 2 million. 2 million share capital here. 2 million. $2 million there. And then we have retained earnings. We have retained earnings. Remember, we are the working for retained earnings. So we'll pick the working. We are the working for retained earnings. So we'll pick the working. I don't know if it's working what. Let's check. Retained earnings. We are the working for retained earnings. Retained earnings is working 3. And it was group retained earnings was 1,759. Here. 1,759. So you see why we start with the working before we can start consolidating. It's very important because when consolidating, you end up just picking the figures. 1,759 retained earnings. The next thing we slot here is the NCI, non-controlling interest. It's our baby. We will slot it here. NCI was a working. It's not working for. Should be working for, I guess. NCI was a working. Yes, working for 906. Here. The NCI is here. 906. Okay. So I can close on the capital elements. Let me add, this just represents equity. 2,000 plus 2 million plus 1,759 million, then 906. 906,000, that will have a total of total equity. This is just total equity. Total equity. I'm getting $4,665,000. $4,665,000. That's it, total equity there. And then I go to liabilities, because this section is equity and liabilities. I go to liabilities. Liabilities, we've got two types, the non-current. Non-current liabilities. Okay, so non-current liabilities, we've got the loan stock. We've got a loan. The loan stock, what are the values of the loan stock between the two companies? Loan stock at 4%, we've got the 500 and 100, so that makes 600. 500 and 100 respectively. $500 plus 100 gives me 600. And then we have current liabilities, which is the last part. So we're almost done. Don't lose heart. Don't lose heart. We are almost done. So under current liabilities, we have trade payables. What were the values? Between the two companies? Trade payables 680 and 350. 680 and 350. $680 here plus 350. We've got 1,030,000. We've got 1,030,000. The last one is overdraft. What was the overdraft between the two companies? Bank overdraft, so it's only CMU that has a bank overdraft for 560. So we can't even add. We'll just take it straight because it's only one company that has the bank overdraft. So 560 there. And then I can find the total here. Total equity and liabilities. No, let's do this. Maybe let me just find the total current liabilities. Let me find the total current liabilities. When I add this and that, 10. Okay, let me just find the total liabilities. Total liabilities will be 600 plus 1030 plus 560. 2,190,000. This is total liabilities. Let's see, judgment is made here. We'll see if what we're doing was making sense. So now we have total equity and liabilities. Total equity and liabilities. I need to shade it in yellow. There's a reason. So total equity and liabilities, how did I write this up to that far? We're supposed to end there. The zeros are already there on top. Okay. So total equity is, you can see total equity is 4665 plus total liabilities 21960, which is here. So 4665, 2190 is giving me, it's giving me 6,855,000. Fantastic. So we've consolidated the statement and it has balanced. As you can observe, our total assets are equal to total equity and liabilities. Remember, the accounting equation is the representation of the statement of financial position, which is the balance sheet, where we say assets is equal to capital, which is equity, capital plus liabilities. So if total assets, which is 6,855,000, are matching with total equity and with total equity and liabilities, which is 6,855,000, it simply means that we've balanced off the consolidated statement, and this brings us to the end of the tutorial. Thank you so very much for following through. Thank you so very much for following through.